And the top story that we're tracking, of course, comes by the way of worsening geopolitical tensions in West Asia in the past 48 hours that have raised alarm bells through Asia. The Iran-Israel crisis may result in higher gold and oil prices, stock market rout, among major fallout if the war escalates. Now, apart from the global oil trade, gold and bond prices, Indian stock market are expected to also face the ripple effect of the Iran-Israel crisis. Any significant escalation in tensions may lead to panic selling and volatility in the global equity market. To discuss further the impact of the ongoing war and what will entail for India as well as Asian markets, joining us is Vivek Kumar. He's an economist at QuantEco. Kartik, Malhotra here with me in the studio. Vivek, I want to come to you first. The major question I think that everybody would be eyeing this morning would be, what would be the impact on Indian markets of the ongoing war?
Hi, good morning, Shweta. So we are watching this situation very closely because most of our macros in terms of projections for FY25 are premised around the assumption of crude oil prices remaining stable at 85 to a barrel, $85 to a barrel. So this was probably very close to where it was in terms of its average performance in FY24, which was around 83, $84 to a barrel. So that question of macro stability will come to the forefront if oil prices were to escalate. We all know that our trade deficit is somewhere close to 42%, 43% determined singularly by crude oil prices. Our inflation metrics are pretty sensitive to crude oil prices, especially on the WPI side. When we talk about inflation, there's a wholesale price inflation which the producers face, and there's a consumer price inflation which the consumers face, obviously. The WPI inflation is much more sensitive and much more vulnerable to global commodity prices vis-a-vis CPI. That's because CPI first, the weight of fuel prices are lower compared to WPI. Second, the government often via oil marketing companies intervenes in the retail price market, and you could say that delays the adjustment vis-a-vis international price signals. So in some ways, the WPI captures the signal on really, I would say, on a live basis. The CPI probably dilutes that signal, and the signal gets staggered. So there are current account deficit implication. There is an implication on inflation. Last but not the least, there is also some implication on growth because, getting back to first principles, growth is nothing but the summation of consumption, investment, and net exports. So when net exports, which in case of India is a deficit situation normally, if that were to widen, let's say because of higher oil prices, you will see some bit of drag also coming in terms of growth performance.
All right, and we of course want to go through each of these parameters one after the other, but let's talk about oil a little bit. Oil prices escalated to about $92 to $93 a barrel as on Friday. They've come down this morning to $90 a barrel. What sort of impact are we looking at oil prices? Are people going to, do you suggest the oil prices trajectory will remain perhaps on the lower side going forward?
As far as international prices are concerned, I think there are various factors at play. The number one factor, I would say, is the geopolitical unrest, which has been continuing for the last 18 odd months. And the recent strike by Iran kind of just adds fuel to fire. So right from the time, the Russia-Ukraine war started, and then within a very short span of time, you had disturbance in the Red Sea and the Israel-Hamas conflict. In the past 24 months, we've been seeing periodic outbursts of geopolitical conflict, which is keeping oil prices somewhat edgy. Now, while you could argue that the situation hasn't much changed in the last 3 to 4 months, well, it is probably happening at a time when there are increasing signs of global economic resilience. So talk about US, talk about Europe, talk about India, talk about even for that matter, China now, and Japan. Most of the economies have now started to post higher than expected activity numbers. So in some sense, you would now see, in fact, have already started seeing an upgrade to growth scenario. The expectation earlier, 3 or 6 months back, was that the global economy is going to see a serious slowdown. That is not playing out. So the global geopolitical uncertainty is happening at a time when there are upgrades to growth. So that kind of naturally gives a buffer to crude oil prices. The best guess at this point in time, Shweta, would be that 90-95 could be a stable range. But then we are not commodity experts, and we know that commodity prices are extremely, especially oil prices, are extremely whimsical when it comes to geopolitical triggers. So one trigger overnight can lead to 5%, 10% move in crude oil prices within a span of a week.
Okay, Vivek, hi, good morning. I also want you to throw some light on the trade routes, which now obviously, like they had been compromised with the Houthi attacks on the Red Sea. Now, with Iran actively participating in the conflict, and any sort of retaliation from Israel could mean that the Suez Canal now gets, blocked for a much longer time frame. The impact on trade, especially for India, is going to be fairly mammoth. How do you see that panning out in the case of an escalation in the conflict?
Hi, Kartik. I think that's a very relevant point. The only savior I would say in this case is that probably the merchants have already diverted a large part of the shipments via the Cape of Good Hope. So if you recall, the crisis actually started way back in November, and maybe in December it kind of escalated between as far as the Suez Canal route channel is concerned. And most of the shipment, as we believe, whether we are talking, so we are in talks with some of the corporates who are exposed to exports as well as imports. The feedback that we are getting is most of the rerouting has already happened, and that is also evident if you see the traffic vis-a-vis the Suez Canal channel and the Cape of Good Hope channels. There has been a nearly 65% drop in the Suez Canal traffic, day-to-day traffic, and concomitant increase is observed is in around Cape of Good Hope. So large part of the vessels have already undertaken that route. So as far as the trade numbers are concerned, if, we have trade data till February, and the disturbance started sometime late November and the early part of December. So in the last 2.5 months of trade information, we have no evidence to suggest that there has been any material impact on India's trade performance. So whether this will not have any impact on trade performance going forward, I think that's a brave call to take, because uh, the there is a majority of the shipments have been rerouted, but there is still certain bit of shipment which do pass through the Suez Canal route. So maybe there could be some impact there as well. And the recent episode by Iran in terms of the escalation of conflict between Iran and Israel tells you that the situation is probably getting closer to a boiling point. And if that were to worsen, then I guess there can be some spillover impact. How much will depend upon whether the routes which are still, whether the ships which are still taking the Suez Canal route, whether they are incentivized to go and take the Cape of Good Hope or not. If that were to happen, I think more than the setback will be on inflation coverage, because we know that the shipping costs have gone up, the insurance costs have gone up, and all it does is, let's say the tanker is not taking the Suez Canal route and going by the Cape of Good Hope. It adds to anywhere close to 14 to 15 days of extra travel time. So you not just have an extra insurance cost, you also have an extra fuel cost, and the entire logistics cost will now be higher. So more than trade, I guess trade you could still live with it, because barring perishables, which probably will not survive the extra 2 to 3 weeks of additional burden, but most of the other merchandise items will probably survive that additional 2 to 3 weeks of extra time. The implication will be on cost, and items where if you are importing where there is scope to pass on that cost will get passed on. That is why I'm more concerned on inflation than on trade per se.
Okay. I also want to pick your brains on gold prices. Gold prices already escalated to all-time high in the first week of April. The impact of perhaps the ongoing escalations on gold prices, as people dial in to their risk premium and start hedging, do you see gold prices scaling to an all-time high once again in the month of April? What sort of impact are we expecting?
So gold is seeing a structural demand, I would say. So we'll have to delineate the cyclical demand and the structural demand here. And structurally, gold in the last 2 years has seen buying from central banks, and this has its roots in the Russia-Ukraine conflict. because the way Russia got delineated from the entire global financial system has now incentivized some of the emerging market central banks to kind of create that extra buffer and create that extra insurance for themselves. Let's say in case of a global financial attack uh, were to happen. So central banks are prepping up for that. They are, in some sense, they are building buffers. China is doing it. India is doing it. All the central banks who have the wherewithal to do it are in fact doing it. And that's a structural change which has happened. We don't know what is the RBI's balance sheet number in terms of actual volume impact on gold. That number will be published in the month of May when they in the month of June, sorry, when they release their annual report. So we'll get to know what exactly has been the volume impact. The price impact is already seen in case of the FX reserve data, but we would be more interested in knowing how much extra volume RBI has amassed. So we'll see that. The other bit of buyers which have emerged is obviously the traders or the speculators who are speculating on the geopolitical conflict. Again, as I said, last 2 years, we've seen a series of geopolitical conflict, which is adding on to that momentum trade of the geopolitics feeding into higher demand. So in some sense, both are feeding into each other. Uh, Last but not the least, inflation is still proving to be sticky worldwide. And as long as that tendency is going to be displayed, there will be some extra hedge against inflation demand as well. But for me, I think that would be a peripheral demand at this point in time. The active demand is coming from the bigger players like the central banks and the speculators who are speculating on the global geopolitical unrest continuing some form.
Vivek, one last point before we let you go. What about interest rates? Because there were hopes that there would be some interest rate cut. In came the US jobs data and all hopes pretty much washed away. And now another shock in West Asia or Middle East, depending on where you're looking at it from. Do you see any tinkering with interest rates now as far as US Fed is concerned anytime this year?
Well, interest rates actually have come off since Friday because if you see, US yields have actually come off, and that has to do with the safe haven demands. So whenever there is an episode of global volatility, typically you run to safe haven as assets like gold and US Treasury. They are considered to be one of the most safest in the entire world. So US rates have benefited, but as far as the broader question, I think the Kartik which you raised was what happens to the monetary policy cycle. So monetary policy cycle will get, or the monetary policy makers will probably get much more cautious because if oil prices were to rise, it is going to have spillover impact on inflation globally. We are already witnessing inflation showing some signs of stickiness, and a lot of central banks are yet to reach their target levels. So if stickiness prevails at a time when you actually not hit your target, and when you know that there are upside risks to inflation in the near term because of commodity prices, you probably just be more cautious. So markets, as of now, are they've completely priced out the June rate cut, which was there in the system just about 2 weeks back. And as things stand today, market participants are expecting just about 2 rate cuts from the Federal Reserve this year. Now, if Fed comes down with respect to its anticipated dose of interest rate cuts this year, then this will get reflected in the other central banks as well, especially in case of emerging markets. And there will be spillovers in terms of the monetary policy cycle elsewhere too.
All right, Vivek, thank you very much for joining in this morning, for sharing your thoughts on the likely impact of the ongoing crisis in West Asia. We continue to track all those details for you here on News 9.